Do I need a holding LLC for each of my real estate LLCs, the ones that hold rentals? And the answer is no. What's really cool is if you look at this diagram here, each of these LLCs, and then they're from bad states, they all flow down to the Wyoming holding LLC. In law, each of these LLCs are separate beings as long as you keep the corporate formalities, like I mentioned. We don't commingle money and things like that. In law, these are separate beings, and so liability is contained right here. So it doesn't flow down to the holding LLC, and then you own the holding LLC, or your living trust will own the holding LLC. And what that does is that gives us the ability to go ahead and, from a tax standpoint, lessens the number of returns, and we get the same protection. So we only need one holding LLC, and then for our cash, we're going to need what I call the bank LLC. What's cool about this, what I just said is, I just mentioned that it also lowers the number of returns you have to file. A lot of accountants hate it when I mention this, because what they want to do is they want to go ahead and not put together the holding LLC, get rid of this, and now they have to do a return here, 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 and here, and it helps them stay afloat and make more money. What we do is we make all of these LLCs disregarded, and now this LLC will go ahead and file a return, but the others do not. Pretty cool, right? So your accountants aren't going to be too happy about that, but you'll be very happy about that. That doesn't mean that we don't keep separate books and records for each of these LLCs. Every once in a while I get a client who says, hey, can't I just go ahead and just bring all the expenses under one, like QuickBooks account or bookkeeping method? I really like to go ahead and break these out and have a ledger for each of these LLCs. The reason why, again, learn from my past. When I've just compiled all of the expenses for each of my properties into one ledger, I wasn't able to ascertain which property was my dog property. We all have dog properties, right? We get into them. Hopefully we get out of them. But let's say this Texas property here just costs us so much in repairs, fees, things like that, that we're not maximizing that return on investment. Well, if it's all lumped together, can you really ascertain that this is the at-issue property, the problem property? No. So I really want you guys to do a P&L on each of the LLCs. I also like to have each of the LLCs have its own bank account. Okay? Now, there's always asterisks to it too. Sometimes we can use one master account, but that's going to be a small exception to the rule. Reason why I believe each of these LLCs should have its own bank account is a simple fact that each business that I know of, just think of any business like all over the place, each business that I know of, separate business, has its own bank account, correct? So it's commercially reasonable. Now, with flipping, we have a little bit of a leeway to go ahead and move that out and use the escrow account as the bank account too. So how many LLCs can we go ahead and put underneath the holding LLC? As many as we want, unlimited. We got the best thing about that is we do have the separate nature and the law to back it up, that each of those LLCs is a separate being. We have two. Now let's switch gears. We get into flipping property. Again, how many people in here would flip property if the perfect opportunity came along? Great. Everybody, right? We can either contribute money to the corporation. Like I said, we're going to be flipping properties to the corporation. Or at least having the tax ramification hit the corporation so we can avoid dealer status. We can either contribute money to the corporation, fund the corporation's another word for that, or we can loan money to the corporation. Reason why I would recommend you guys loaning money to the corporation is because when you loan money, what are you able to get? You're able to get security and be in first position. Does this make sense to everybody? Okay, so I prefer going ahead and having a secured interest in the actual flip than not. Here's how it works. if you realize this, again, we get to separation. Now, since we're doing business in the state that we're flipping the property in, we need to be filed in that state. Now, the problem is I'm going to show you a list of all these bad states, and you're going to say, well, should I just stay away from doing flips in that bad state because there's not great asset protection? Answer is no. Where do we do deals? Everywhere, wherever the deal is, right? So sometimes we're going to go to these bad states, but again, we want liability containment. This is almost taking your LLC structure and flipping it upside down. We've got the corporation here, but here's the deal. We don't want to do our flips in the corporation. If we do the flips in the corporation, now liability comes up. Tax-wise, it's great. Tax-wise, it's just fine. No problems there. But when we get to liability, we've got to realize that here, if we went ahead and did a flip in the actual corp, we just kept doing flips. Now all of a sudden we sell this one, that goes away, this one goes away. And then we built up some cash and capital inside that corporation. Murphy's Law, right? Murphy's Law, I'm a big believer in Murphy's Law for my life, okay? Whenever the most inopportune time something bad to happen, it's going to happen, right? So Murphy's Law would be that you kept on upgrading your flips. Next thing you know, this flip causes the problem, or there's some issue with it, you get sued, the corporations are going to get sued, and you have your most expensive flip going on. What happens in that regard? Now that's at risk, right? So we don't do it that way. We don't do flips through our actual corporation. We separate and conquer, and we go ahead and form an LLC in the state where the flip is. And we do the flip in this LLC. Let's just go, that was our first one. After that flip is completed, we kill it. Now I'm going to give you a little bit more than I normally do because this class is a little bit more per echelon when it comes to grasping concepts. There's a procedure we need to do. We sell the property, we reconcile the bills, and we wait a little bit. Make sure no surprise bills come up, right? And then we close the bank account, and then we close the entity. I see some aha moments going on here. These are things that people don't think about. What happens is that I see them want to close the entity and then try to close the bank account. Well, you can't close a bank account on an entity that does not exist. So they have to refile the entity, close the bank account, and then close the entity down. Okay? And again, we walk you through this, but I just want to expose these concepts to you guys as much as possible. We can go ahead and secure and protect our flips by doing what we call a friendly lien. We could go ahead and have the Wyoming Holding LLC or our banking LLC would be more likely. Loan the money to the flipping LLC. And then what happens is we encumber and get in first position, get by a deed of trust. But here's the deal. We actually need the paperwork. We don't do things kind of half-assed here. If you enter into a loan agreement, you're going to have a promissory note, right? And that's your evidence. I see a lot of other companies just say, yeah, put a friendly lien against all these properties, but when it gets scrutinized by the court, it wasn't done at an arm's length transaction and it gets unwound. Does that make sense? So belt and suspenders approach when we do these type of things. All right, I really wanted to get into a question.
When you do that, you actually have to give the consideration or just the paper?
Okay, this is a cool question. All right, notice how I said we can enter into a line of credit? Well, we went ahead and extended that line of credit to that flipping LLC, right? They don't have to take the money. They can. But as long as we go ahead and extend the line of credit and have a line of credit agreement, just like with your HELOCs, they still are, you would still put the encumbrance on the property. Does that make sense? So yeah, but we would want we we would want the agreement put into place. If you didn't do that, then you could run into an issue.